Well, good morning, everyone. We'd like to welcome you all to today's webinar on captive insurance basics, and we want to thank you for choosing to spend an hour of your day with us today. I know everybody's really busy this time of year, so we're just grateful to be a part of your day. As we go through, feel free to send in any questions that you might have or think of as we progress through the webinar, and we'll try to address those at the end of the presentation, or we'll respond individually after the presentation if we run out of time today. Just before we get started, we got a few housekeeping items that we'll cover. I'll introduce our speakers, and then we'll talk a little bit about the CPE considerations and our agenda. So our first presenter for today will be Scott Bailey. Scott's a native of North Carolina. He's proud to serve clients across his home state. Scott has over 15 years of experience in public accounting and internal audit, and he's worked with Fortune 500 companies, small and mid-sized sector leaders, as well as closely held businesses. Scott's practice has been focused in the insurance, construction, and manufacturing industries throughout his career. Scott's also active in the Raleigh community, in organizations in the accounting profession. Scott has taken on multiple committee roles in the AICPA, as well as the North Carolina Association of Certified Public Accountants. Scott is a CPA, as well as a certified information systems auditor and a certified fraud examiner.
Good morning, everybody, and thanks for joining in with us.
Our next presenter for today will be Matt McDaniel. Matt is the audit manager in our Montgomery office. He has over 7 years of experience in accounting. Matt has worked extensively in the insurance industry, working with group self-insurance funds, guarantee funds, captive insurance companies, as well as risk retention groups and other service providers. He works on about 40 insurance audits as of today, and he also serves on the Alabama State Society's Young CPA Committee and holds a CPA license, as well as the Certified Information Systems Auditor, the Certified Fraud Examiner, and recently completed his Associate in Captive Insurance certifications.
Hey, good morning, everyone. Thanks for joining in.
And I'll be the moderator for today. I've spent the last 20 years working in the insurance industry with Carr, and Ingram. I've worked exclusively with standard carriers and the alternative risk market, including captives, risk retention groups, self-insured group funds, guarantee funds, as well as third-party providers and others within the industry. So many of you may be wondering about CPE certification for today. Today's webinar should provide 1 hour of CPE. You should receive your CPE certificates within the next 24 hours. So if you will, just be on the lookout for an email. The email should come from certificates@simplecert.net. If you don't see it by tomorrow morning, maybe check your junk mail. And then if you still don't see it, reach back out to us. We'll provide our contact information towards the back of the presentation, and the presentation slides will be forwarded out to everyone. Also, we will have polling questions throughout the webinar today. So if you will, please be engaged and respond to the polling questions as they count towards our ability to note who continued through the entire 50-minute session. And lastly, we'll talk about the agenda before we get going. So we'll basically be taking about a 50,000-foot view of the captive insurance industry today. We're going to talk about what is a captive, what are some of the common types of captives, how do captives work, what do the daily operations look like, what are some considerations that you should think about as you consider maybe forming a captive or what type of captive, and then lastly, we'll touch on some recent developments. Our hope for today's webinar is that we can provide you with a general overview of the industry, and as we develop more industry-specific content in the future, you'll want to log back in and spend some time with us. So we will start today with a polling question, and again, remember you'll need to respond to at least 2/3 of the polling questions today. And our first polling question would be, how would you describe your knowledge and experience with captives? Who are you and what is a captive? I've heard of captives, but I'm not sure of all the benefits. I'm a captive owner, manager, or support professional. Or like some of us, you just want the free CPE, but thanks for asking.
really interested to see where these numbers fall this morning.
And so far, we've got about 72% are voting. And we'll give it a little bit of time and see if we can get that number to inch up a little bit. But so far, we are trending towards I have heard of captives, but I'm not sure of all the benefits.
That's great. We're talking to a good audience today. That's excellent.
So we're about 84%. I'll give everybody just a few seconds to make their selections, and then we can kind of close out. All right, so looks like we had about 70% that said they have heard of captives but are not sure of the benefits, followed by about 16% that are actively in the industry. That's kind of a good thing for today's webinar because our goal is to kind of provide a basic intro today. And with that, kind of looking at where we're at today in our general audience, I'll kind of hand off to Matt McDaniel, and Matt is going to introduce us to kind of what is a captive and cover some of the industry terms and definitions that would be helpful to understand.
All right, appreciate it, Steve. So before we dive into captive-specific topics, just kind of wanted to go over a brief overview of some terms that we'll see throughout the webinar today. Starting off with risk. Risk is pretty much everything, right? Everything is at risk. Risk is any situation that involves exposure to danger or loss of something of value. And then we get into coverage. Coverages are the risks that are being transferred. Deductibles, that's the risk of loss that's going to be retained by an insured before that risk is transferred. Then we get to premiums. Premiums are going to be the cost that the insurer is charging the insured to write the coverages. Reinsurance, that's going to be when an insurance company cedes off risk on coverages that it writes to another insurance company to kind of hedge the risk that's involved. Underwriting is the process of actually writing the coverages. And then risk transfer and risk distribution. These topics will be covered in a little bit more detail later, but risk transfer is the actual process of moving risk of loss from one risk-bearing entity to another. Risk distribution is the process of pooling risks together that are typically similar, and the reason for doing that is to reduce the overall risk of the coverages being written so that one single loss doesn't have a catastrophic effect on the insurer. So when we talk about a captive, what is a captive? The NAIC defines a captive as a wholly owned subsidiary that's created to provide insurance to its non-insurance parent company or companies. Captives are established to meet the risk management needs of the owners or members that form it. And they're essentially a form of self-insurance where the insurer is owned wholly by the insured. Once it's set up, a captive operates basically like any other commercial insurer. It issues policies, collects premiums, it pays out claims, but it doesn't offer insurance to the public. It's regulated as a captive rather than a traditional insurer. Essentially, captives provide insurance for hard-to-find coverages or coverages that would be too expensive to get from a commercial carrier in the open market. And the reason for this is just to better manage the risk of the insured. A captive is going to follow the same cycles as any other insurance company. Underwriting, loss cycle, reinsurance cycle if that's applicable, and investment cycles. The main difference is that it's controlled by the owners. And typically in a captive scenario, there are no employees. All the day-to-day activities are typically going to be handled by the captive manager. And we'll get more in depth on the day-to-day operations later on. So a brief history of captives. They go back several centuries to the 1600s, when London ship owners met in a Lloyd's coffee house in London to write down, the names of their ships, the cargo they were carrying, and basically assess the value of all of the cargo that they were carrying, and attempt to share the risk of loss if any one of their ships were damaged or lost. And this was actually the basis for what's now known as Lloyd's of London. The actual term captive, though, wasn't used until about 1958 by Fred Rice. He founded American Risk Management, and after Rice formed ARM, the U.S. government, through legislation, made it extremely difficult, which should be translated into very expensive, to operate a captive. In response to this legislation, Rice ended up working with Bermuda, and in 1962 formed what's considered to be the first modern captive. Bermuda and the Caymans were the first two countries to then formalize captive legislation. And throughout the 70s and 80s, Bermuda and the Cayman Islands had emerged as centers of alternative risk, mainly in part due to hard commercial market for coverages that were either unavailable or unaffordable. So by the 1980s, there were over 1,000 captives. Most of these were primarily offshore. And by 2010, there were over 6,000 captives worldwide. 30 U.S. states by that point had formalized captive-specific legislation. And in 2014, there were 1,000 captives domiciled in the U.S.
Matt, just real quick to kind of tag on to that, is I was kind of looking at some studies that said, just to kind of show how much this industry is growing and booming, by 2018, the U.S. had over 3,400 captives licensed across the U.S., which compared to Bermuda, which had, I think it was slightly over 700, and the Caymans that had slightly over 700. So we can really see this is an industry or market that's really taken hold in the U.S. and is growing.
Yeah, and
yeah,
especially in the context of the hardening insurance markets, we're expecting further growth, certainly in the short term, in the captive world.
So by this point, you're probably wondering, why should I form a captive? Well, there's several benefits and reasons for that. First being a reduction or stabilization in your insurance costs over time. You're able to have more control over the underwriting and claims management processes because you're writing coverages for things that you know about. The financial benefit is another, and that's going to be in part due to you having the claims experience for your company or organization. You'll be able to get coverages for things that would typically not be available in the commercial market, or if you could get them, they would be too expensive to actually benefit you. Direct access to the reinsurance market, as well as possible income tax benefits over traditional self-insurance. And Scott will be talking more about those income tax benefits later on in the webinar. Which brings us to common types of captives. When we talk about captives, there's several different forms that those can take. And the three that we'll be talking about today are going to be a pure captive, single parent, group association captive, and what's called a sponsored captive, or also commonly known as a rent-a-captive. We'll get into each one of those in the slides coming up.
And I think it's important to note that there are several other different captive types or captive structures. These are just the three that we see the most of in our practice, and that at this moment we think are probably the most common. So just wanted to kind of chuck that in there as well.
And so when we talk about a pure captive is going to insure only the risks of the parent or the parent's affiliated companies. This is probably one of the most common forms of captives, and it's also referred to as a single parent captive. With a pure captive, it's going to offer the highest level of control and flexibility, as well as the highest retention of underwriting profits. One of the drawbacks of a pure captive is the potential for it to be a little bit more costly to start up, but those costs would be offset by these benefits shown on this slide. When we get to group or association captives, these usually consist of entities that are within the same organization or same industry, I should say, and they pull together. This could be something like a group of doctors or a group of trade associations that all would be facing similar risks. Association captives can only insure the risks of the association members, though. This is an effective method for sharing costs and pooling risks for similar groups or associations. However, there is less control over the operations and finances than other captive types. Some of the other benefits to an association captive could include providing affordable and needed coverages that might otherwise be unavailable for those associations, revenue generation for the association, and it can also be used as a tool to increase association membership through participation in the captive. Sponsored captives also are referred to by several other names: cell captive, incorporated cell captive, protected cell captive, series LLCs, segregated cell captive, and rent-a-captive. Essentially, they're all going to operate similarly, whereby they're going to consist of what's called a core, and then have multiple cells or series that branch off from that core. This captive is going to insure the risks of separate, unrelated participants or risks in each of the cell or series through series agreements or participation agreements. What the core does is it serves as a administrative or general account that manages the operations of each of the cells for a fee, and the cells will conduct their own separate individual insurance activity.
And what we typically see in these arrangements is that the core will hold the insurance license, and it will perform the insurance writing activity, the underwriting activities for the other cells. So we see that in a number of arrangements, either through what we call quota share agreements. It's a very flexible structure, Matt. So
it's also one of the faster growing captive types in the U.S. If you go back to Delaware, was one of the first to start with the Series LLC legislation and kind of took off from there. Montana, of all states, has a strong Series LLC captive industry, and then we all know Tennessee has really taken off as one of the cell captives. A lot of cell captives being formed there. So over the last probably 4 or 5 years, we've really seen a push in the sponsored captives, whether it be the Series LLC structure or the protected cell structure. kind of emerge in the states, and it may eventually overtake the group captive or the pure captive in the states. It'll be kind of interesting to watch and see how that develops.
Definitely, Steve. That seems to be the way things are trending, at least from what we're seeing in our practice.
Yeah, I mean, these are more appealing. Typically, I mean, because the lower startup costs as compared to a pure captive, you're not having to put up front all of the startup capital that you would in a pure captive situation. And for that reason, it's sometimes referred to as a rent-a-captive, where cells may also be referred to as protected, segregated, or incorporated. You're basically just paying money to, jump into the structure that's already set up. With an incorporated cell, these seem to offer the most protection as they're separate entities for both tax and business purposes. Again, each cell is its own separate taxable entity. They've got their own EIN, their own tax returns. They have to, qualify as an insurance company the same way as, any other type of captive would. And with these, each state statute is a little different, but by law, each cell has to be a separately identified company.
So real quick before we move on, guys, I had a question that came in, and it said, is there a level of premiums that an organization should start to look at or look for when they're starting a captive? And, I would say that it kind of varies. I've seen, depending on the type of captive, which I know we'll go into a little later, I've seen premiums as low as, $200,000 or $300,000 for certain coverages, up to the million. So, in my opinion, it kind of depends on what type of losses or is the company looking to insure, and what type of coverages that they would be anticipating incurring. What are your thoughts on that?
I agree with what you're saying, in that there's really a lot of flexibility there. Kind of the key thing, and we'll touch on considerations for captive formation a little later in the presentation, but this is probably a good time to sort of dig into this point briefly. But it's going to depend on, as Steve said, the coverages that are being included in the captive, what coverages it's going to write. It's also going to depend on, one of the things to keep in mind is that there are some operating costs for the captive. We are talking about setting up a new insurance company, so there's going to be a little bit of fixed costs. Although one of the beauties of captives is that there's very little overhead, almost none, particularly compared to traditional options that are being absorbed through the premiums that are being charged on the commercial market. So, definitely an interesting question. Steve, would you say that we normally see, I would say the normal range is somewhere between 450,000, 500,000 in premiums up to about on up. I would say the floor typically starts probably about 500,000 or so. Does that sound consistent to you?
Yeah, I think that's pretty consistent, especially in the cell captives and the group captives. Typically the single parent captives, you can really have a big range depending on how large the company is that's forming the captive. So I think 450, 500 is probably a good start. When you get into some of the cell structures, you may be doing some very specific type coverages that might bring that down a little bit.
Certainly, and definitely, as the coverages move into some areas that have higher loss potential, or where there's higher claim experience for the insurance being moved into the captive. I guess this is as good a time as any to move on to our next polling question.
All right. So I would describe the industry I work in as insurance or risk management, construction, manufacturing, or other for-profit enterprise, governmental, not-for-profit sector, banking and or financial institutions, legal, accounting, or other professional services. We got responses coming in pretty quick, and it's kind of a toss-up.
Steve and Matt, I think it's really interesting to see this because we see some different types of coverages being included in the formations. They vary so greatly across many industries. What are y'all's thoughts on that?
Yeah, I mean, the types of coverages that you can write with a captive, since they fill in so many holes that a typical insurance company, may not offer. It's one of those things where it can be applicable to a huge range of industry.
I agree. Let's see. So we're at about 93% having voted. Give it just a few more seconds, and then we'll close out the poll, and we'll take a look at where we landed. All right, so you can see the insurance and risk management, construction, manufacturing, or other for-profit enterprise were kind of the two heaviest, and then legal, accounting, or other professional services, and then followed by banking and or financial institutions. So pretty diverse audience today.
Absolutely. Good to see. Good to know we're talking to a lot of folks from a lot of different areas. And at this point, good morning, everybody. This is Scott. I've been chiming in here or there throughout the presentation, but I'm going to pick things up from here. And we're going to talk through at a very high level how captives operate, how they do what they do. There's four main components to it, although if we really want to get down to it, the first point we have listed where it comes to selecting a captive manager, that is absolutely critical in the early stages of captive participation, that you find a captive manager that you want to work with, that you work well with, and that understands your company and the types of insurance that your company needs. Basically, that they understand the risks that you're exposed to and can help you develop strategies for best managing that risk. The next 3 points we have are largely focused on the formation of a captive, and once the captive is formed, most of those are no longer significant to the operations. Although those do come up from time to time, as a captive may have changes in its business plan, or sometimes captives move from place to place, meaning, and when we say place to place in the insurance world, we're speaking about domicile.
Hey, Scott, real quick, yes. Could you reshape your screen? I think it's stuck on the polling question right now. Sorry to interrupt.
Okay. It is, I've moved on to captive operations on my side. Is that, are you seeing that, Steve? Where are you?
It still froze up on the poll. I'll see if maybe Nathan can reset that.
All right. Well, while Nathan is working on that, just to sort of list what's on the slide here, sort of the four main topics of discussion here, as I touched on them very briefly, the first one being selection of a captive manager to assist you in the operations of your captive. The second one being completing a feasibility study. Again, this is largely at the beginning at the formation of a captive. Choice of domicile. So this is going to be where the captive is located from, either which state it's incorporated in or if it's offshore. And the last point I have listed is the approval process with the relevant Department of Insurance. Have we caught up on the slides, Steve?
We're not there quite yet. Trying to get it online.
Okay.
Hold on just a second.
Okay. I'll pause for just a moment. While we're paused, I think this is probably a good time for us to kind of discuss this. I'm going to speak about the details of a captive manager as we're moving forward, but I think this is probably a great time for us to talk about, our involvement, how we're involved with captives and with captive managers. Steve, would you want to speak on that very briefly?
Sure. I think we just got the slides back up as well. But from our end, typically we'll come in and we'll help with audit or tax services, or we may assist with feasibility studies from time to time. We work with various managers, throughout the states, a couple offshore, and we just try to build a relationship there so that we can help refer any clients that we have to typically we may refer 3 or 4 managers that the client reach out to kind of discuss what they're looking for, types of coverages, things of that nature, and then the manager will kind of work with them to determine if an onshore or offshore structure might be more beneficial or the domicile of choice. And I know those are some of the things that you're going to go into a little bit, so I won't spend a lot of time there, but
not stepping on any toes here, so that's perfect. And I think the slides I've caught up here, so I'm going to dig into some of the details on a captive manager. So as you're exploring the world of captives, it's important to know how these things work, because what we're talking about, as we've said a couple times during the presentation, is the creation of an insurance company. It's a small insurance company. All it does is write coverages and pay claims. For the most part, there's no employees, there's no brick and mortar to maintain or things of that nature, but it's still a company. It's an insurance company. And most of our clients who participate in captives are generally not insurance companies. So the actual doing of insurance is a little bit of a foreign concept to them. Most of the time, our clients are familiar with premiums, deductibles, things of that nature, things that we're used to very commonly from a consumer side or business environment from that aspect of it, but not from the actual underwriting and claims administration side of insurance. So selection of a captive manager, as I said on the previous slide, and as we talked about a little bit, is essential. And these are groups who make a business out of forming and managing the operations of captive insurance companies. So, basically what they're doing is they're dedicated to maintaining the operations of those captives. And so, given that those are the main point with what's going on with the coverages, with the risks, it's very important to be with a captive manager that that you trust, and as we've said a couple times, that understands your business and understands your risks and how best to mitigate those risks in a responsible way. They're responsible for underwriting the coverages that are being written. So this is, the writing of policies and establishing a premium, which is then charged to the parent or the captive participants. They're also responsible for claims administration. So this is not just writing a check for claims, but this is in receiving claims, determining which claims are valid claims to be paid by the captive, which claims are not valid claims. A very important part of the process, as we'll discuss a little bit later in the presentation, they're responsible for a lot of the administrative activities. So these are state and local filings, where necessary, federal filings, filings with the relevant departments of insurance. They file the quarterly and annual financial reports. Again, these are typically with the relevant departments of insurance. Each captive is required to file an annual statement, which is a regulatory report, and those are due at varying times. And they're also responsible for maintaining the relationships with third parties. So many captives will every captive, almost every captive we're involved with has an actuary to value how many expected claims are coming based on what's been received, what we know about from losses that have been incurred. The actuaries take that data and determine a liability of claim, what they expect those claims to be, what they expect the final payouts to be. So they play a very important role in the process, the actuaries, and the captive manager is responsible basically for quarterbacking that relationship. Additionally, many captives are involved with third-party administrators in some cases. So these are another company out there that is receiving and paying claims, but is doing insurance business with our captive. And several still also have investments included in the captive to fund the reserves for future losses. So that's a very important role for the captive manager, is managing those third-party relationships. As we noted before, this relates primarily to the formation process in general, but captives are required to perform a feasibility study, which tells a Department of Insurance that what they've got is a workable plan. So this is basically, we're telling them that the captive plan that we want to put in place, our captive program, the risks that we want to cover and that the captive is going to charge a premium for, are legitimate risks, that these are good risks. It's a projection of how much risk the captive is taking on. Also, very critical to those departments of insurance are the capacity. So a Department of Insurance's first concern is going to be on the solvency of a captive, that basically that this captive can pay all the claims that it's going to get and still exist. So that capacity element is very important. And then also the general cost to operate the captive. Again, this is typically at the front end of the formation process, and at that point, we kind of move on from that. Also important to our captives is going to be the decision on where the captive is going to be domiciled. There's about 20 to 24, would you say, Steve, primary domiciles within the United States? I think that's about the number we typically see, as well as some offshore options. And each domicile has its own unique characteristics, its own benefits, and its own costs.
That sounds about right. We actually had a couple of questions that kind of came in about domiciles, and my thoughts to where was one of the questions related to what would attract somebody offshore versus a domestic captive, and my thoughts towards that were that up until maybe 5 or 10 years ago, there wasn't a lot of domestic activity, and some of the domiciles domestically had a high entrance cost, high capitalization levels. But in recent years, most states have kind of revamped their legislation to make the capital requirements less, so that they're more competitive with the offshore domiciles. Would you agree with that?
I do agree with that. There are obviously some tax implications to consider, both from benefits offshore versus onshore. Certainly if you go offshore, the tax impact is largely going to be duties charged by some of those offshore domiciles rather than income tax. However, then down the line, what we've got to think about is how do we get that money back onshore from offshore, as those captives develop surpluses, large surpluses. And then domestically within the U.S., each domicile, it's a little bit all over the place. There's a lot. Each different domicile has its own flavor.
Right.
And then as we're moving through the captive formation process, this is generally the final step, and this is approval by the Department of Insurance. The approval process is going to include an application to form the captive, the feasibility study. It's going to list out the service providers that are going to make the captive operate, and as well as their credentials and things of that nature, basically to show that the people working on the captive, assisting with the captive, are qualified to do so, and hopefully of upstanding moral character. It's going to include the captive's business plan, basically how is this thing going to survive, as well as some of the typical, as some people would say, lawyery stuff, the bylaws, articles of incorporation, so on and so on. And then at that point, if the department likes what they see, then at that point they issue the certificate of authority, and we move on to acquiring the insurance license. So that's perhaps a little bit long-winded, but at a high level, how these things work, how they do what they do, and also a little commentary on how they are created. And at this point, we're going to talk about some of the considerations, primarily from a reporting standpoint, but also some other considerations, including some tax considerations. As we said earlier, every captive is required to file annually an annual statement with their domicile Department of Insurance, and many of them require quarterly filings as well. In almost all cases, not all cases, but almost all cases, captives are required to obtain audited financial statements on an annual basis. There are some limited exceptions to this, but on the whole, these are going to be audited annually. Like any other insurance company, they're also subject to examination by regulators. So the departments of insurance have the right to examine the captive. At some point, it's going to happen, but in general, if we've done our due diligence, we've done our work, and we've gone through those steps of operations we discussed earlier, we're working with a good captive manager. Generally, these are not a big problem. So, but it's important to know that it's out there, and they can do it, and at some point will do it. Compared to the three above, this last point we've listed on the slide relating to the investment policy may seem somewhat small, but the reason why we felt it was important to include in the content today is that this investment policy is going to show us and show the Department of Insurance how the captive plans to build up surplus. So how it plans to build up these differences between premiums and losses, basically to fund future losses. So this is going to tell the Department of Insurance, and it's going to tell us, either CRI as auditors or other users, it's going to tell them how this captive plans to take those differences and how to continue to build that surplus within the captive. Again, in the event that, we're talking about insurance, in the event that bad things happen. And this is going to lead us into our third polling question.
And I believe this will be the final polling question for today. Let's see. To which domicile would you prefer to travel for your annual board meeting? And our choices today are Georgia, Alabama, North Carolina, South Carolina, or Arizona. And I do realize that these are all domestic. I would like to go to Bermuda maybe, or the Caymans, but we do have all domestic domiciles today.
Well, Steve, it's that January grind. We got to get back in the swing of things, unfortunately.
Can't be going too long.
That's right.
The votes are coming in pretty quick on this one, and there is one emerging domicile that looks popular. It's actually a domicile that's growing and is a nice place to visit. It has a lot of spas and retreats. You can probably guess that is not in the southeast section of the U.S. Let's see. Oh, it's changing a little bit. Well, it looks like we're about 92%. We'll give it a few more seconds, and then we'll close it down. All right. So Arizona did hang on to the lead at one time. It was 40% of the vote. Out of those choices, I would probably prefer Arizona.
I think that's a good choice.
Yeah.
Good option here. All right, perfect. We're going to pick it back up as well, and at this point, it starts to get a little technical, just because from here we're going to talk about some of the key elements to keep in mind with your captive. We're going to talk a little bit about. We're going to bring back some of those definitions that Matt discussed early in the presentation, and discuss some of the implications of them on our captive. Particularly as we're looking at them through the lens of either a federal regulator or through a state Department of Insurance. So at this point, I'm going to get a little bit heavy. I'm going to cover these things at a pretty high level, but just keep in mind that these are significant to the operations of our captive. The two things that we have highlighted here on this slide are risk transfer and risk distribution, because these are essential for us in being able to say that our captive is writing insurance. If we haven't either transferred risk from one place to another, if there's not an actual transfer of risk, we're not meeting the definition of insurance according to some of the case law from the IRS. And the same thing with risk distribution. As Matt had said earlier in the presentation, what we're really looking for is that we've gathered together enough similar risks in the coverages written by the captive that if there were one or two single claims, that they wouldn't wipe out the solvency of our captive. And what we're trying to achieve here with risk distribution is basically, as we pool together all these different risks, we smooth out that risk. And again, really what we're trying to do, this is a focus on solvency and the actual writing of insurance, really as you would see with a carrier, just at a smaller level. And there's a variety of tools available to achieve that. In some cases, the use of risk pools, which are third-party companies out there, and really what they do is they kind of package risk. So they will buy risk from one company and pool it together with the same or similar risks from several other companies, and then sell it back to diversify the risk in those instances. Some other implications that are not quite as heavy as those two, they're at times related party transactions that we see with our captives, either notes to and from shareholders or the parent company. One thing just to keep in mind there is that early on in the life of a captive, that could create some scrutiny with the Department of Insurance. Really what they want to see, particularly in the early days for a captive, is that captive is focused on insurance, that it's focused on risk management.
Hey, Scott, I think also in the early stages that could create some scrutiny with the IRS as well. Until that surplus is built up and the captive is really well capitalized, if the IRS comes in and examines and sees a lot of loans or notes to shareholders, and you may touch on that briefly, but that's an area that not only does the department look at, but the IRS looks at as well.
Absolutely true, Steve, and thanks for chiming in with that. Absolutely true. We also see some unique structures in these where they're invested in subsidiaries of the parent company or other companies. Again, as with the notes to and from shareholders, just important to keep in mind that those could draw some scrutiny from third parties that are looking into the details of our captive. Additionally, in some domiciles, they will allow parents to utilize a line of credit where they write a line of credit to the benefit of that Department of Insurance for use as capital in starting up the captive. And usually this is done basically to reduce the upfront capital cost in forming the captive. These particular domiciles like it. Generally accepted accounting principles doesn't really like it, but that kind of is what it is. So we move on. And then some captives, depending on how they're structured relative to the parent, sometimes we see those consolidated into the parent company. So those situations can arise as well. As Steve was talking about, there are some tax considerations as well. One of the most important things when it comes to choice of domicile is going to be how the premium tax is charged, and this is tax levied on the writing of the premiums, and that varies from place to place. Even in some states, they'll require a captive to pay to file a premium tax return, also file a state income tax return, and basically whichever one is higher, that's what the state is charging. So there's only a handful of those, but important things to keep in mind. More significantly, at the federal level, this is where things really get interesting. So insurance is taxed under IRS Code Section 831A. And then there's also a subchapter B there, or what is it, subsection B. But I promise you that's as code heavy as I'm going to get on this call. But this is an important distinction to make between our 831A filing insurance companies and 831B filing insurance companies. 831A insurance companies file a return like normal. It is what it is. They file an 1120 PC form rather than a standard 1120. 831Bs, on the other hand, get a little different treatment. And for these companies, these smaller companies, these are captives that write premiums of $2.3 million or less and meet certain other criteria. We'll touch on it very briefly shortly. Basically, when they file their return, they'll file that 1120 PC, but they will only be levied tax against their investment income. Their underwriting income will not be taxed under the 831B status. However, again, with every blessing, there's also a cost, and we'll talk about those a little bit later as well in our discussion of recent developments. So as we were discussing briefly, the 831B election was expanded under the 2015 PATH Act. This was an act that passed through Congress, and it basically increased the premium levels allowable to make that election from 1.2 million to 2.2 million. And at that point, we saw a dramatic increase in formations of captives looking to file under 831B, basically trying to take advantage of that favorable tax treatment. There's some technical tests required in addition to the premium limit, as discussed below. I'm not going to get into the details of that today, but it's just important to know that they are there. Over the last 20 years, there have been some significant revenue rulings affecting captives. Most of these relate, on the whole, to what is risk transfer and what is risk distribution. Pretty much every one of these, in some capacity or other, touches on those two topics, risk transfer and or risk distribution. And then in leading up to our next slide, before we get there, I'll call attention to Rev Ruling 2004-65, where the IRS recommended that 831B captives were no longer identified as listed transactions. We saw that flip in 2016, where the IRS changed course and called 831B captives transactions of interest. And at this point, they required some additional disclosures of who is involved in the captive transactions. Basically, some general information on who is a participant, who's touching the captive, who is touching the risk. So at this point, they were signaling to all of us that they were looking and they were paying attention. And probably our last slide with technical content. These are four of the most significant pieces of case law over the last 10, 15 years. We start with Rent-A-Center, which was a win for the petitioner. And in this case, the central issue was about risk distribution. As we move on to the next three, however, and I think I may miss the years by 1 year each, but Avrahami was in 2016, Reserve Mechanical was in 2017, and Syzygy, kind of a strange pronunciation, that decision came down in 2018, and the IRS won each of those. But it's important to note here, because what was at issue in these cases were 831B filing captives. But the IRS didn't actually challenge that election. In each of these cases, what they challenged was, are they actually writing insurance based on what we believe to be that definition? And again, focusing on, is there risk transfer? Is there risk distribution? And then they also keyed on, is there actual risk of loss? They're writing insurance, but is there, are there claims that will be paid? Because what they don't want to see is a situation where someone is writing insurance, taking advantage of this favorable treatment for small insurance, but there's really kind of sort of not really any risk of loss. They're really keying in on that. And they're also keying in on, is the insurance practiced in conformity with what they consider to be insurance norms? So are premiums being actuarially determined, basically to cover future losses, things of that nature. So even though we've seen some losses for captives over the last few years, one of the things we have been able to do is we've been able to learn what the IRS is looking at. We've been able to determine what they consider to be a favorable fact pattern and what they find to be acceptable. And it's also important to note that that some of these cases are still on appeal. So I know at least the reserve mechanical case is on appeal. So there may be news yet to come on some of these. But despite some of those risks, I know for us, we believe that captives make an excellent risk management tool. They're great ways to structure risk in a way that can provide benefits to you, to our clients, and it gives us more control over those risks. That's really the key thing to keep in mind, is that it puts our hands back on the levers of managing risk. There's some tax advantages that we discussed briefly. But again, the focus needs to be on risk, and it's essential that we're doing our homework when it comes to captives, that we're making sure we know what our captive is doing, we know who we're working with, and that we're partnered up with good accountants and good captive managers to make this a successful program. And that's all the content we have prepared for the day. Steve, do we have any questions? I think we've got about 2 minutes before our time is over today.
Yeah, we are kind of running short on time. We've had a few questions come in that we've tried to answer individually, and we'll reach out if any others come in later. But one of the things that I thought about when you were talking about the cases where the IRS won, when people are looking, there were 3 there where the commissioner won. And I believe in at least 2 of those, there were either no claims submitted to the captive insurer until the IRS's examination had begun, or there may have been only 1 claim. And I think on that claim, there had been no investigation into the claim at all. So I think, when you're talking about the relationship with the manager and the formation of the captive and the setting the company up to be an insurance company, is just a critical to keep in mind. But kind of other than that, I guess one of the questions that came in was what's going on between captives and the IRS currently. I believe we kind of talked through that a little bit. One other question that might be worth talking, you hit a little bit on this, but what did the first few years of ownership and captive operations tend to look like as far as return of dividends, the building up of surplus, potential IRS scrutiny? That's kind of a big question, but
it's a big question, and we're running out of time. But I'll touch on it very briefly, and it's kind of an important thing to keep in mind as you're moving through the captive formation process. But what we typically see is that people start small. They start with a coverage that they know well, that they feel like they've got some control over, and they typically start there, and they'll start, taking a little bite. They'll take a little piece and put it in the captive, manage that, And once they get a good program working with that, maybe they'll take a little more of whatever risk they're writing. They'll bite off a little more of that. They'll take a little more of that risk in the captive. And then over time, they take more and more. And then what we see is that they branch out into different coverages. So we'll see multiple different coverage types starting to enter the captive. So I think that's kind of the key lesson in the first few years is to start with what can make it a successful program, and then build out from there. It's a long-term strategy that requires a long view of risk and risk management.
Hey, we did have one more question. I know we're out of time, but we did have one question that just came in, and it was, could we touch a little bit on how the funds are managed and where they're held and how they're typically invested within a captive environment?
Really, we see that vary from captive to captive. That's going to depend on, what coverages it's writing, but mainly it's going to depend on how frequently you need access to that. One of the things that we would view as a concern is if the funds or investments of that captive are in a place where they're not very liquid, not liquid enough to pay claims. So I know that for us would be a concern, and I would hope that would be a concern raised by the captive manager as well. So it's really going to depend. One of the things the regulators, the departments of insurance are going to look for, again, their focus is on solvency. So they're going to be looking for things that are going to provide stable returns to fund those losses. But as these programs mature, those investments can mature as well, and they can change and branch out as those captives build surplus. But it's a mixed bag, and it's a little bit all over the place.
All right. Well, we better wrap things up. Again, we want to thank everyone for your time today. And I will just remind you that both Scott and Matt's contact information is in the back of the presentation. If you think of any questions or anything you'd like to discuss, feel free to reach out to us. We got a couple of links there where you can contact us here at Carr, Riggs and Ingram. And again, we just want to thank everyone for your time and spending a little bit of it with us today. Hope you have a great afternoon and a great rest of your week.
Thanks, everyone.